Good morning, everybody. Welcome to another Daily Market Report brought to you by Mike Bjork. Today is Monday, and it's November 14th. Hope you guys had a great long weekend here as we had Veterans Day on Friday. Hope our vets enjoyed themselves. Hey, we got actually nothing on the economic calendar today. We do got this week actually quite a bit. From Tuesday through Thursday will be actually pretty packed. We got stuff ranging from manufacturing to inflation numbers to housing on there, so it's kind of a mixture of what we have this week here, but it will be pretty action-packed Tuesday to Thursday with a little bit on Friday. Today we just happen to have nothing on the docket here today, so we'll jump right into it. Headline news: stock market's a bit mixed. Primarily Dow is up slightly right now, whereas the other two, Nasdaq and S&P, are down right now. They were all up earlier, but then they pulled back a little bit after being only open a little bit on Friday with the long weekend here. A lot of it is, again, the post-election repositioning. So the investors are kind of repositioning themselves as to prior to where they were and thinking of where the economy is going to be going. As a result, we're seeing a lot of global yields continue to rise as well. So right now you see the Deutsche Bund, for example, it's up to 0.3%, whereas was about less than 60 days ago, it was actually negative 0.2%. Oil's gone down to about $42 a barrel. And all this actually is on top of some weak data that came out of China. So typically, if we see some weak data coming out of China, we would see the stock market kind of react negatively. But they're so focused on potential of what the economy is going. So they're kind of thinking that, because Trump on his election results or his campaign was all about cutting corporate tax returns, personal income tax rates, building infrastructure. So a lot of this is kind of taking into place that, especially on the infrastructure, borrowing about $1 trillion to try to create better infrastructure in the U.S., that we could, get a sudden surge in inflation data right now. So right now the Fed funds rate, of course, is now increasing. It's about 85% of a possible rate hike next month here. A lot of this is going to play over time. So they're just projecting right now, and once the president comes in, it's going to take time for anything to really kind of get into it. He's probably still he's still working on his cabinet for once. A lot of this isn't going to play out that immediate. So it's kind of funny how things are working. So they're all basing a lot of this on forecasts of what they think it will go. So a lot of this could be on a temporary basis. So let's go ahead and see how the bond market's reacting, and we're down quite a bit. Right now we were shrinking a little bit, but we were down as much as 84 basis points from where we left off on Thursday. Pretty big drop. That's almost 1 point for the funding. As if you guys haven't heard this before, these are basis points. 100 basis points equals 1 point. So let's say if a par pricing or no point loan is at 4%, that would basically be almost about 1 point now costing you today as a result of where the bond market keeps moving. So as you can see, we got this trajectory here, and there's been a sharp decline as a result. So the money is coming out of the bond market. It's going into places like the 10-year Treasury. It's also going into places like the stock market with more risky assets, because they're figuring that the economy is going to be growing. They want to jump in there and get on the bandwagon and watch the economy grow. So they're forecasting big things coming into the economy now that Trump's going to be elect here. So I'll have to kind of wait and see. The last time we were down this low is right around beginning of the year, really, January. So we were actually down to about 99.59. So it's possible we could drop as low as about 99.59 before we could see a improvement again. So we do have a little bit more room potentially for a drop. So if you guys are floating out there, it's better to lock in now before we go any further down. So it's possible we could go further. Just to be on the cautious side. Will we improve? I think at some point we will, but it may take a while for us to kind of get back to any of these levels again. We could be, December we might get a little bit of improvement, especially when they do the rate hike. Typically what happens is when we have inflation, that's the biggest fear for bonds. That's one reason why we're selling it. They think there's going to be inflation jumping up. Whereas before there's concerns about deflation, and now that there's possible inflation concerns, which erodes the value of the bond over the length of the term. Bond usually lasts about 30 years, and over that time, if there's high inflation, it's going to take away that value of that bond, which is why you're seeing a big sell-off right now. All right, folks, so interest rates, of course, jumped up quite a bit since last Thursday. Be cautious. Again, we could potentially drop down to this low, as this is where the low where we were back in January. So there's possibility for more room. So I would kind of start locking in now. Obviously, hopefully it locked in sooner than that. But if you're still out there with any interest rates, any locks, I would try to lock in as soon as possible. All right. So, anyways, folks, if you guys want to get more updates throughout the day, feel free to stop by Twitter. I do post updates throughout the day here, and at Mike Bjork. All right. So you guys have a wonderful day. We'll see you guys tomorrow. Thanks so much for watching. Bye-bye.